Hey everyone, it is Jay Soloff from Investors Alley, and this is our options trade of the week. So let me begin by saying that this is not an actual trade recommendation. This is for educational purposes. If you're looking for my actual recommendations, I have a newsletter called Options Floor Trader Pro, which actually we just closed a couple 100% winners in there in Kamiko and Marvell. And that's the sort of thing where I send out actual trade recommendations. This here is for educational purposes. If you really like the trade, you're certainly welcome to do it, but that is not one of my recommendations. I'm just showing you some different examples of how you can use options. And this week we're going to look at Bank of America. So we're here at marketchameleon.com, a great site for looking at options analytics. And if you look in their unusual options page, and I like to sort it by volume, I'm looking at Bank of America, and you can see this was an overall down day. You can see all the names on top with the big red numbers, but banks did relatively well. So bonds dropped quite a bit, and yields went up, and a lot of stocks sold off, except for banks, where that's a good thing when interest rates go up. So you can see a lot of action in XLF, the financial sector, and Bank of America was up 2%. And it did about 2.5 more options than normal, almost over 650,000 options, with 66% of those being calls. So that's typically a bullish sign when a lot more calls are traded than puts. So if we actually look at that, the one I wanted to look at here was this very first one here. So big trade, 17,287 in a 3-leg trade. So this is not necessarily the sort of thing, well, actually, I'll take that back. If you own the shares, this is definitely the sort of thing you can do at home. And likely what was going on is this is a put spread collar being done against shares, which also could explain why it's this odd number. It's someone, fund or large investor has a lot of shares that they want to protect in Bank of America through May expiration. So in this case, what they did was, it looks like they bought a put spread, so the 38.34, so that protects it. This was at 39.50, so that protects it down below 38 all the way down to 34. In order to finance that spread, they sold a call at the 44 strike, so that still gives about $4.50 of upside potential before it gets capped out. Meanwhile, that 75 cents was used to finance this put spread here, which cost about $1. So this whole trade costs about 25 cents. So it's not a lot to spend basically to protect your downside down, about 10, so where are we? 39. So, down about almost 20%. So 15-20% down, you have protection. Below that, you don't have any more protection, but banks don't tend to be that volatile, right? So this protects the downside in return for capping the upside, but still provides, almost, 15, again, that same sort of 15-20% upside potential as well. So very smart trade if you own a lot of Bank of America shares, or if you own any Bank of America shares. Good way to make sure that you can sleep at night. Also, the sort of thing you can do, you could do components of this one if you want to protect your downside, or if you want to do a covered call. So this just kind of combines some really good strategy, protection, and overriding in sort of one spread, and again, usually called a put spread collar. So if we want to look at that here, let's look at Bank of America, and you can see obviously this clear upward trend, right? As interest rates have crept higher and bonds going lower, you can see the financial sector is improving. Kind of a big move today, and that's when this took place. So someone probably already owned the share, either that or was done in a separate transaction. All right, and then looking at that, again, you don't have to do all these components at once, right? So if we go to May here, which is 64, so just a bit over 2 months. You can see here though the activity. Look, you can see here the activity. These two strikes, 38.34, and then 44 here, and you can tell by the open interest that these were all opening trades. So yeah, you don't have to do this all at once. You could do a put spread if you wanted to do something like this. You could do a put spread like such, just to be a vertical spread, 38, 34, where you're buying the 38, selling the 34, and then separately you're selling that 44 call. So this is the same thing. You don't, again, with commissions so low these days, you can do things in legs. You can do these different spreads in legs, and you're not really changing the edge of your trade because you're paying so much in commissions. This is, two separate commissions, but they would be relatively low. I mean, assuming you're doing of course, if you're doing 17,000 lots, then obviously commissions will be higher in that sort of case, but obviously that's a different situation. So if you're just doing a small amount, like 10 here, this would protect 1,000 shares. Not that big of a deal to do it in two separate trades. All right, so if you're interested in more sort of directional trading, I mentioned earlier Option Floor Trader Pro. Check it out. There's a link on this page. And I will be back next week with another trade.